Welcome back to Getting Your Shit Together, the podcast where we break down financial and real estate news in a way that makes sense, without the jargon. I am Neil Joseph, and always I'm joined by my co-host, Jerome.
Hey everyone, glad to be back in today. We have a very interesting topic to start off with. So, the Bank of Canada has made a big decision in dropping rates today. Neil, do you want to share the good news?
Oh yeah, for sure. I think as anticipated, and there was a lot of back and forth, I would say, in the last couple of days. The bank did deliver on the expectations that the market had sort of developed the last few days, which is a 0.5% rate cut. So they brought the policy rate from 4.25% down to 3.75%. In essence, it means the prime rate is down from 6.45% to 5.95%.
Yay! but really, what does that mean? If you have a variable payment, variable product mortgage, that's probably going to be good news, right?
Yes, I would say on the face of it, it's continued relief. After having seen a drastic increase in interest rates over the last, I would say, 2 years, or at least 2022, 2023, it's good to see some relief. In terms of exact numbers, I would say about $104 of decrease in interest costs since June for every $100,000 of mortgage. I'll repeat. For every $100,000 of mortgage that you have or loan, your interest costs have reduced by about $104 each month.
Since June.
Since June. If we just accumulate all the rate cuts that we have seen till now.
Yeah. Is it really a yay, though, for people who have a fixed payment variable?
It doesn't change anything for them from a payment standpoint, but it does help bring their amortization down drastically. Because while they were making less payments towards principal when the interest rates were going up, they are actually making more payments towards the principal outstanding than anybody who would have adjustable rate mortgage, because the payments are remaining steady.
Yeah. So this is all great news, right? We talked about the payment reduction for people who are on a variable interest mortgage. Wow, that's a lot of variable stuff.
Yeah.
And then we also talked about the fixed payment variable impacts. So how did we get here? What's the deciding factors behind this rate drop?
Before we talk about that, I think just to put things in context, right? So on the way up, we saw about 4.75% increase in the rate.
Yeah.
And till date, we have just seen about 1.25% reduction. So in the bigger scheme of things, this is probably a good rate cut in a regular rate cycle.
Yeah.
But given that we have seen so much of increase, this is just barely making a dent right now. We're not even halfway through the reduction.
Yeah.
So I hope, and my heart prays that there is more to come, but we don't know.
I'm praying right there with you. It always seems like the same like with oil, right? The price of oil goes up and the gas goes right up along with it. And then as the price of oil comes back down, it takes so much longer for the price of gas to fall. This is sort of along those lines.
Yes.
A very roundabout way.
When it goes up, it shoots up like a rocket.
Yeah.
When it comes down, it is more like a parachute.
Yeah.
But anyway, so talking about the factors which are leading to these rate cuts, and I think even from an outlook standpoint, a lot has changed since June. So I was just looking back at my notes, and in June, the anticipation was that we would probably have about 3 rate cuts, and in the year, in current year, 2024.
Yes.
And we have already exceeded that, right? We've gone to an equivalent of about 5 cuts.
Yep.
And we still have one more meeting to go.
Yep.
right? And this has been primarily driven by, I would say, a faster than anticipated reduction in the inflation figures that we'll be seeing, at least in Canada. Sort of elevated rate of unemployment, though it ticked down a bit in the latest report. We are still about 6.5% unemployment across Canada, which is high.
Yep.
And there isn't any much GDP growth to talk about. I think anticipation is about maybe the 0% growth in August. We're still awaiting numbers.
Yeah.
So, yeah, it doesn't talk too much, or it doesn't really translate into a very hot economy, unlike what we have in the United States.
Yeah.
I think these are the reasons why Bank of Canada is probably a bit more ahead in terms of its rate cutting cycle.
Thinking about the unemployment rate and stuff like that, that's something that's really having an impact and hopefully will put a little bit more pressure on future rate cuts in order to make things more affordable, so that way the economy can start to generate more activity again.
Yeah, well, since the difference in the US rates and the Canadian rates are increasing, I am getting a bit uneasy in terms of what the election outcomes might influence. Right, before our next meeting in December, obviously the election results in the US are going to be out.
Yeah.
And those are going to make some, I would say, even if people don't want to sort of factor in, it is going to play out.
Oh, yeah.
Right? So I don't know how much we'll get shielded. And especially one candidate who has been talking big in terms of tariffs comes across.
Yeah.
Yeah. Story might change. Who knows?
Yeah. We're all sitting here waiting with bated breath. What's happening to our whatever you want to call it down in the South. I've called it an older brother before. We could call it the crazy uncle, whatever you want to call it. They're south of us, and when they sneeze, we scratch, or whatever that phrase is. What is it?
I've been just trying to avoid the news cycle lately. Yeah. That is all that we hear nowadays.
Yeah. So obviously this is going to impact what's going to happen in December. And at the moment, our goal or our hope is that they do make another rate drop, because that should help to stimulate some of our economy.
Yep.
But as you just mentioned, a lot of things factor into that decision. And we're sitting at a moment with a thought that it could come down at least 0.25%. At least that seems to be the current consensus.
Yes.
Amongst most of the economists and players that make decisions about this. But there are a lot of things between us and that, between this time and that.
We got about 6 weeks to go, and a lot can happen within 6 weeks.
Yeah. Yes.
Now, let's bring it a bit closer and talk about how it changes things for borrowers
today.
So, what do you think? Obviously, the impact is clear if you have an existing variable rate mortgage, right? Your interest costs go down from today. I think I've already seen announcements coming from the lenders in terms of adjusting their prime rates.
Yes.
Obviously, the existing fixed mortgage borrowers are not going to see any change because they have a fixed contract and it continues till their contract expires or matures.
Yes.
Now, in terms of people looking to buy a home or refinance, does that make a change?
Well, let's look at them two different segments, because I think that there are potentially two very different impacts to each group that you just mentioned, your purchasers and your refinancers. So let's first talk about the purchasers. So does this help the purchasers? In theory, not really. And the only reason why I say that, unfortunately, is because when we are trying to qualify people for what they can qualify for, we're going off of the lowest rates to start with. And at this moment, it is not the variable rate, even after today's announcement. So we're using a fixed rate for their qualifying,
Yep.
Which is beneficial to the borrower. However, it means a little bit less flexibility in how they repay that mortgage.
Exactly. Yeah. And I can see that because I had a few clients who had purchased properties last year, and obviously they had to get a fixed mortgage when they were purchasing, and now they have seen interest rates go down, and they're looking at me and asking, Neil, can I do something to get out of this?
Yeah. Can I have it? What is that? The classic FOMO thing? Fear of missing out? But now that brings us over to the other side, and I'm going to kind of categorize this as refinance, renewals, and transfers. Now, I mean, you yourself, Neil, know that there are opportunities for people who are in that fixed rate to start to look at taking advantage of these variable rate adjustments that are coming up.
Yep.
Does have an impact, though, and it's important to understand what that impact is. So if you're currently in a fixed rate mortgage and you're looking at either borrowing more equity from your home, or, you know, you want to try to take advantage of these lower rates that are coming and you want to potentially break that existing mortgage, what are we thinking? What are we doing to help people make that distinction right now?
So I think the biggest hurdle that needs to be considered is, what does it take to break the existing mortgage? Now, we all know the minimum penalty that any borrower incurs is 3 months worth of interest.
Yes.
Right? And it can be higher if we're looking something like a interest rate differential calculation.
Yes.
Right? It all depends on how much rates have dropped since they secured their mortgage.
And who your lender is with.
Oh, yes, for sure. That has a big impact.
Yes. So, the calculation for this IRD, for the 3 months interest, it's fairly standard, but there are some differences between lender to lender, right?
Yes. Yes.
Some lenders will use the 3 months interest calculation based off of where you're at the time you break the mortgage. What do other lenders do?
Some lenders might look at, again, if it is a variable rate mortgage, they might look at the prime rate qualification, or the interest rate based on a prime rate, not necessarily factoring a discount.
Yeah. Yeah. And so, for example, I know there's a bank out there that we usually refer to with 3 letters. The first one starting with an N, so I'm not going to fully give it away. But when it comes to breaking a penalty or breaking a mortgage and it's a variable, they'll use the 3 months interest penalty, but it's going to be based off of whatever the benchmark rate is, irregardless of your actual rate. Credit unions tend to be somewhere along that lines as well. So it's not all equal. And then when you start looking at the IRD, so right there we were just talking about breaking a mortgage using a 3 month interest penalty calculation. When the IRD comes into play is when the amount is higher than what that 3 month interest penalty would be, because it's always whichever is higher. In other words, the bank is saying whichever one is going to make me the most amount of money.
Of course.
Different lenders handle that part differently too. I personally say categorize banks and credit unions in similar groups and other lenders in slightly different groups, because they'll use different starting points in order to calculate the penalty, and some are a little bit more favorable for a client than others.
Don't forget the cashback.
Oh, yeah. Yes.
Right?
Yeah.
So in case borrowers have received a cashback at the time of securing a mortgage, they probably have to pay everything back, or at least a prorated amount. Yeah.
Those bonuses might just be bonuses right now. So, yeah, you have to take that into consideration as well. And it's important. And so this is some of the things that Neil and I would do, is we would look at your current rate. We would make a determination, or at least an estimation, of what that penalty would look like, whether you're in a fixed or a variable, and then compare that to the new rate offering that's available, and then give you some feedback on, will it save you any money? Will it give you that penalty back in savings? And that's the goal. You should at least be able to get the penalty back in savings.
Yeah.
And then some afterwards in order to make it worthwhile.
And nothing to get depressed about, because there are opportunities. Like, I was reviewing a file this morning and found an opportunity where the client could save over $12,000 in the remaining 23 months that they have on the contract.
That's amazing.
Mm-hmm.
That's amazing. That's like going up to somebody and just saying, "Hey, would you like $12,000?"
I know. That's after having paid $11,000 in penalty.
Yeah.
That's and still incredible. Saving. So overall, their interest costs were coming down by $23,000.
That's incredible.
Like $1,000 a month.
Yeah. I don't even know how to say how much that impresses me so much, because there are times when borrowers will just, it's like when you renew just with the lender and you just sign on the dotted line and don't even think about it, or you do the same thing with your insurance. Take the time to ask the questions. What can we do? So as far as the strategies go, what's the biggest message that we want to give to people right here?
So again, I think there are a couple of scenarios which apply, right? So things will vary if somebody is looking at a renewal today. And what I have been recommending to people who in that situation is maybe try to buy some time. You do not have to lock yourself into a situation if you have the flexibility. For example, if somebody is going for a fixed rate mortgage or ending a fixed rate mortgage and the renewal is coming up soon, like November or December or even sooner, they do have an option to take a variable rate mortgage, even though the payments are probably going to be higher than what they have today.
Yes.
If they can wait out 6 months and are willing to take that chance, maybe they will get a better fixed rate option, and which they can convert into for free.
Yes.
So that's one option. Again, it's not a generalized recommendation, but still something that some people may be able to consider.
Yeah.
Now, you could have people who are looking to break an existing mortgage and try to lower their interest costs. Especially these would be people who got a mortgage in the last 1 to 2 years, maybe paying 5% or higher, right? And for them, the question becomes whether they take a chance with the variable or they take whatever is assured and on the table today, which means they're probably looking at a fixed rate option.
Yeah.
So it's a bit difficult choice for them.
Yeah.
That's what I feel.
I agree. While some aspects of mortgage pricing or rates are technically impacted by the stock market, you don't have to follow it like it is the stock market.
Oh, yeah.
That's our job. That's what we do, right? We watch the rates every day. We get emails in from lenders. We look at what's happening with the bond market. We look at all of that stuff to make the best determination. Right now, we are expecting to see another reduction in the variable rate, as we've mentioned, and we do anticipate seeing a slight reduction in the fixed rates in the coming months as well. Again, very, very cautiously mentioning again that we have no idea how the election down south or any of that's going to impact the way these rates move for us. But at this moment, this is sort of the anticipated projection. Yeah. So if you're in a fixed rate, obviously today's announcement doesn't really mean anything to you other than, maybe at renewal time, you might want to consider a variable because it is dropping. Mm-hmm. So if that's within the next year or so, definitely something to look at. Might give you the most amount of flexibility.
Yep.
If you're in a variable and you want to go fixed, I agree with what you're saying, Neil, is to maybe wait a little bit longer because we do anticipate seeing it come down. We talked about people looking to buy a new home, people looking to either refinance or renew their existing mortgage. we can transfer people out too. Like if they're in a fixed and we want to take them to a different lender, there will be a penalty, as we mentioned, but it's definitely possible to do. There are some situations where that can't happen, though.
Yeah.
Do you want to touch on that very quickly?
Oh, yeah, for sure. Make sure that nobody's taking a restricted product where the only way they can get out is by sale of the property.
Yeah.
Or at the end of the term.
Correct. So now that we've talked about all of these, impacts of the interest rates, and we talked about the fixed and how you can change and all that kind of stuff. So if somebody is sitting today and they're trying to decide, do I choose the variable? Do I choose the fixed rate? What are some good things to consider for the individual buyer or borrower, rather, when looking at these two things? Like, what are some good factors for them to take into consideration here?
I would say the first and foremost is what is their outlook for the next couple of years in terms of not just the mortgage, but what are the plans with the property, right? So if somebody has a plan to upgrade or sell their home, they definitely do not want to take a term which is longer than what their plan entails, right? So don't choose a 5-year mortgage if you plan to sell in 3 years.
Yeah, of course.
That's one. So thing to avoid in that scenario is, of course, a fixed rate mortgage, because your penalties could be higher to break out of it.
Yep.
And so your natural choice becomes a variable rate mortgage, even though it might come with higher risk in terms of what your payments could be.
Yes.
Yeah.
So
then obviously there are aspects around what is your general outlook and comfort level with payments. Are you comfortable with fluctuating payments? Or you just want something which is steady and just goes on month to month without you having to borrow in terms of where the borrowing costs are or where my bond yield is, whatnot.
Does everybody get it right? Like, you always talk to people and they're like, oh, I've got this and I've got that, and it always sounds so good. But does it work that way for everybody?
The truth is, you will only hear from people who got it right.
Yeah. Yeah. That is so true.
And we don't get it right, because I know I've had a couple of mortgages and I would say maybe it's a 50% success rate for me.
Yeah. And that is one of the risks of having a mortgage, right? Of trying to choose which one makes most sense over the long term, as well as which one makes sense for me right now. We don't always have the answers for everything that's going to happen tomorrow. But we can tell you, based on what we see today, what is the thing that may make most sense for you. And and that's all anyone can ever base a decision on, unless they have a future plan. You need to make sure that you include that plan into whatever your decision making is. And if you're working with a broker, or even if you're going direct with a bank, make sure you got them guys informed too, so that way you can make the best decision.
Thanks for tuning in to another episode of Getting Your Shit Together. We hope today's conversation has helped provide some clarity in terms of recent interest rate changes and why they should matter to you. Well, welcome to another episode of Getting Your Shit Together. We've got another interesting topic lined up for you. And the topic is car payments and the impact of car payments on your mortgage eligibility. So, Jerome, you want to maybe give us a background in terms of car payments and why do they factor in?
Yes, I would love to. Car loans and leases, when they're in your personal name, and maybe we can even come back to that in a minute, they can significantly impact the ratios on your file, because it becomes part of your total debt ratio. And lenders use these figures to figure out what you can qualify for.
So does that mean that all kinds of payments are taken into consideration? Or is it just car payments?
Yeah, of course. So
how about insurance payments?
Good point. Non-insurance payments. You can have insurance payments for lots of different things, and not a single one of them impact your total debt servicing.
And what is the difference? Why is that the case?
You know what? I don't have an answer to that question. Seriously, I don't. I don't know why they wouldn't be, and I don't even want to say it too loud, just in case it ever changes. Yeah, I think because it's more of a optional. In the lender's eyes, it's more of an optional thing. The government says no, insurance isn't optional, at least for a car.
Yeah, I don't think OPP will agree.
Yeah, yeah. I think our point here is that if you're looking at buying a home, think carefully and definitely seek out the advice of your mortgage person, whether it be Neil or whoever it is you're dealing with. Look at the impact of what that is going to have just on your ratios and your buying power.
So is there a general benchmark that people can follow, or they should always reach out to a broker in terms of how high their car payments can be?
So I think as a given rule, people would say that your car payment shouldn't be more than 10% of your pre-tax income. Which, well, 10% would include your financing costs, whether it be a lease or a loan. Mm-hmm. Should also include your gas and fuel, as well as your insurance costs on that vehicle, and maybe even factor in a little bit of maintenance. Yep. So not more than 10% of your income should go to your vehicle is basically what the general rule is.
And as far as mortgage, I would think eligibility sort of considered. I would think anything more than 5% is obviously going to start negatively impacting the eligibility in terms of the mortgage.
Yes.
Right. It starts with $1, but I would say 5% is kind of the normal figure that generally people can use.
Yes. And so the reason why is because when lenders look at your income and the debts that you have and are going to have, so your housing costs plus your other debts, they don't want to see more than a percentage of like 44 to 46% of your income going towards your housing costs and your other debts, so to speak. And other debts are things that show up on your credit report.
Yeah, and when I say 5%, it meant all kinds of debt payments, not just your car payments.
Yes. Yeah. So that 5% doesn't mean, hey, I can, my income's $10,000 a month. I can take 5% of that and go out and buy a car or whatever.
They can't buy a house with $10,000.
Oh, exactly.
They may very well spend $10,000.
Yeah. So there is a rule that some people use, and they say it's 20, 4, and 10. Mm-hmm. No more than 10% of your pre-tax income should go towards the transportation expenses. Yep. You should have 20% down at least for the purchase of that car, so that way your financing cost isn't overly high, and you shouldn't really finance it, or at least the recommendation is to not finance it for more than 4 years.
Wow. And I think the norm today is 7 years or more?
Yeah. I just took my car in today for an oil change, and I thought, well, I'm sitting at the dealership. What is the price of this thing over here? Cars are reaching hundreds of thousands of dollars, and not overly fancy cars over $100,000. That's very near what I paid for the house that I currently live in 22 years ago. So it is not just the purchase price, right? If I look at insurance, it keeps going up each year.
Yep. Your fuel costs have obviously inched up over the years.
Yeah.
And then this is all eating money that you could otherwise have saved.
Yeah.
Or not spent, used towards down payment or saved towards retirement or whatnot.
Yeah.
And obviously, in the process, it is reducing how much of a mortgage one could get.
Yep. So we talk about the payment impact on your qualifying amount.
Mm-hmm.
What about sort of a non kind of direct impact, which is your credit score? What happens there?
Yeah, so every time that somebody goes and checks with the lender for a loan, you could be going to your bank or maybe a car dealer, and you would find that with each inquiry that you make for a car loan, it has a direct impact on the credit score. I know from personal example, when I came to Canada, I had gone to a couple of banks.
Yep.
I had gone to a couple of lenders, and everybody felt free to just pull credit and decline me. So the next time I looked at my credit report, I did see a big difference. And now those inquiries lasted for 7 years? They don't just fall off.
They stay on for 6 years in Ontario. Yeah.
So it can have a lasting impact, at least in terms of inquiries and why you made so many.
Yes.
And a more short-term impact in terms of the impact of the score.
Yes. And I'm glad that you shared that story about your going and checking at a couple of different places and each place pulled.
Mm-hmm.
But I don't know if you knew this, Neil, that sometimes you could go to like a used car dealership and they won't just pull it once. They'll send your file to 4 or 5 different lenders and each one of them will pull it.
Yeah.
So it could happen no matter your behavior, right? You could go to one place and they could spread it out to 4 or 5 different lenders. So there's 4 or 5 different pulls. And if they say no, you could go to another dealer or a used car place and they'll do the same thing. And then before you know it, you've had 8 pulls on your credit report.
And with the same lenders.
And with the same lenders. So what I would probably recommend to anybody who's looking for a car and you're going to go to a used car dealer, ask them how many places are going to be looking at your credit application. Mm-hmm. And maybe even before you go to a used car dealer, consider talking to your bank to find out what they would give you for a loan. So that way you have a bit of an idea and you're not just relying on the dealership or the used car dealer for that reason.
Mm-hmm.
Sometimes that 0% financing can seem really, really good. But if that's going to impact you somewhere else, definitely make yourself knowledgeable of what those impacts are.
Especially if you're closer to buying a home or deciding to buy a home. Right? I think these things make a much bigger impact.
Yep.
You do not want to be at the verge of a score of, say, 680 or 650 and suddenly find that you're not able to buy that house because somebody made a couple of inquiries. At renewal, of course, the lenders also do check scores. And if there has been a dip since the time that you got your mortgage, it could have an impact. Most lenders, if you have kept up with payments, might auto renew, but you don't know what circumstances are playing out in specific scenarios.
Yeah. So I think the important message here is if you're going to approach a dealership or an auto park, like a used car dealership or something along those lines, definitely ask for like how many places are going to see your credit. Mm-hmm. Just be mindful of what that impact could be and do some research ahead of time.
Yeah.
But the other thing, there's a reality aspect of it too. So let's assume, you decide I do need a car because that commute, right, is going to change and I'm going to have that flexibility. And maybe public transportation is going to take care of what you need. So we decide, you got to buy a car. Here is a budget for you. You're going to use it. What is that budget? Like, what are we talking about here when thinking about that budget? Like, how much can you afford? And what is that going to do to your ability to actually make that purchase happen?
I think the one question that everybody who is looking to make a purchase, and again, a big ticket item like a car, is to sort of evaluate philosophically whether it's a want or a need.
Yeah.
And if it is a need, to what extent you want to spend to satisfy that need. If it's a want, then I would seriously ask you to reconsider what you're wanting to do and how much you want to spend towards that. A need is something that you can't avoid, right? If it is something that you want to maybe drop your kids to school or daycare before you leave for your work, a long commute to office and whatnot, right?
You start
In
to
those
sound like my wife,
circumstances,
Neil.
I've done that before, so I know.
Okay.
So again, it's about questioning yourself in terms of how much you want to spend, and again, maybe using the benchmarks that we sort of mentioned earlier. 20% down payment for the car, not more than 4 years of repayment period, and not spending more than 10% of your salary or pre-tax income towards car payments and associated costs.
Yeah.
Right. And again, another thing to consider is any money that you spend today is money that you don't have for the future.
Yes.
Like, for example, just based on pure, simple average returns, if you spend $1 today, it's $3 that you don't have in 20 years.
Yep.
So multiply by with a couple of thousands and it makes a difference.
Yeah. Less polydent in the future because you couldn't afford it. Stick the teeth in. So it definitely is going to impact your cash flow on a regular basis.
Yes.
And I mean, when you're buying a home, that additional cost of having a car payment now, on top of new costs of a mortgage payment, property tax payments, insurance that you have to get for your home, and then all of the other things, because you don't just have a house and have these payments. You have maintenance costs. You have to cut grass. You have to pay hydro and water and sewage and all this stuff. Are we scaring you yet? There's a lot of things to take into consideration, but with good planning and a good budget and a solid strategy, you can manage it all. You just have to know what you're doing ahead of time.
Yeah, it's all about planning and, like we say in this show, getting your shit together.
Yeah. Okay, so here's a question for our listeners. What's your philosophy? Like, what sort of a policy have you used so far when thinking about buying a car? Is it straight off of need and you get it regardless of the cost? Or are you looking at your overall vehicle expenses in comparison to your overall income? Give us some feedback. Type it in the chat. Send us a message. So the last point that we can discuss is we understand that people are going to need to buy a car, but sometimes you don't have to go for that brand new fancy car that might end up causing you to have a slightly higher interest rate on your mortgage. Mm-hmm. If there is a better interest rate for your mortgage available, I would say take that over the want and even need of a car, right? Lower interest rate on your mortgage may have a longer beneficial impact on the amount of interest that you're actually paying.
Absolutely. And the way I look at cars, it's an asset, but it isn't necessarily a good asset, right? Because it's a depreciating asset and it is not getting me any income at the end of the month.
And that is the true case with most vehicles that people own these days. I mean, there are some instances where it could be different, but in the majority of cases, that is not it. Yeah. You buy a car, and as soon as you leave the dealership with it, it's worth less than it was when you went in. And so that's always an important factor to take into consideration as well.
Thank you for listening in. Hope you enjoyed the show, and see you next time.
Take care, everybody.
Okay, bye.